Good morning. The Thursday morning talk is always an ambitious one, so thank you very much for those who are in the room, and I will try to make it energizing. My name is Ambre Soubiran. I'm the CEO of Kaiko, and Kaiko is a market data company. I'll talk about that in a second. But today we are here to talk about the art of coin selection. What does that mean? How do you build indices, crypto indices? How do you build investment products that gives you exposure to crypto as an investable asset class, and how do you select those coins? So this is what we're going to talk about today, obviously with a very strong data angle. All right, so maybe just a few words about Kaiko first. Kaiko is a global company. We've been around for 10 years, and we basically work with businesses and financial institutions on their crypto data solutions and building data solutions specifically in the context of building financial products. We're a global company. We have offices in New York, London, Paris, Singapore, and Hong Kong, and we are regulated and audited and everything that you can see here. What do? Market data. We do analytics, risk management, quant solutions, we do monitoring solutions, and we do Kaiko indices, and this is what we're going to be focusing on today. Now, the first question is, in order to say how do you build crypto indices, the big question is which assets do you include, and how do you go about the methodology about including assets in portfolios? Just to give you a sheer sense of the number of crypto assets out there, this is a chart that represents crypto assets being listed on centralized exchanges over time since the past, 6 years now. We have over 8,000, almost 9,000 crypto assets listed on centralized crypto exchanges, and that does not include the crazy amount, and we're talking, I think, in hundreds of thousands of numbers of assets listed on decentralized exchanges. So we use the centralized exchange listing as a first proxy to say, you know, there is a first level of filtering, and that is already almost 9,000 assets. So how do you filter that down? The methodology for Kaiko indices and for building a selection of indices relies on 4 things. The first one is the exchange ranking. If you want to build an investable product, and if you want to include crypto assets in your investment product, you need to be able to trade those assets on exchanges that are reputable. So the first part is the exchange ranking. It's a public methodology. It's updated on a quarterly basis. It's entirely transparent and data-driven. And in order to have a crypto asset included in a Kaiko index, it needs to go through our exchange ranking. It needs to be listed on an exchange that is well ranked. Then there is the custody vetting. This is exactly the same idea behind it. It's to say if you want to invest in an asset, you need to be able to custody that asset in a reputable custodian or to have a strong custody solution for those. Then obviously you have the liquidity assessment. Liquidity is extremely important because if you want to invest in an asset, it needs to have sufficient liquidity that you can actually trade it and hedge it. And then finally, taxonomy. This is reference data, and this enables us to divide, sort, and filter all of these kind of assets that are out there, the 9,000 something assets, into groups and subgroups based on their core nature and their usage, and that will enable you to build thematic indices and other kind of ways of filtering this universe of crypto assets. So now, if we look at the top 10 crypto assets, what we see, and it's quite interesting, is that, you know, it's actually not that strongly correlated. Obviously, the industry as a whole has its ups and downs and bull and bears, but if you look at top 10 direct price correlation, what you see is that Bitcoin, ETH, and Sol, you know, top 3 are highly correlated between each other, but if you go down into top 10, it's actually not that correlated. What does that mean? That means that diversification is good in the context of building an investable portfolio of assets, right? What you want is that if you have pure and perfect correlation, it doesn't make sense to have a basket index. Here, what we're saying is building a basket and having a selection of coins going beyond top 3, and also we will see later not too much further out of top 10, is actually very beneficial. It brings diversified exposure. Obviously, within the methodology, you're going to cap the weight that each asset has in a portfolio, but diversification is good. And the other important part is the selection bias, right? If you invest in a top 10 crypto and you outsource the decision of your investment, you're going to remove selection bias from building your own portfolio. So The big question here is everybody talks about Bitcoin. I come from the world of TradFi, and everybody, all my former colleagues for banks, they all say, you know, we invest in Bitcoin ETFs because it's safe and because we know Bitcoin is digital gold. It's safe. We know it. We trust it. It's now a, you know, an asset that is an acceptable institutional investable asset. But are we ready to go beyond BTC? And clearly what we see now is that if you want to get exposure to crypto with a little bit more depth in how you invest in crypto, you now look at this as a growth sector, and you need to not focus on single assets, but build a diversified, slightly deeper exposure to the asset class. In the context of portfolio constructions, obviously basket provide a systematic exposure to that growth sector, and this is something that will mitigate single asset risk and selection bias. Now, of course, from an institutional standpoint, it is now, you know, index strategies are enabling participation in the sector innovation at large and the market leaders beyond just Bitcoin and ETH. And this is what we're trying to achieve with proposing a basket strategy here. So, the big question, how many crypto assets are investable? We clearly, you know that 9,000 is not the right number. What is the right number? How do we get to a number where we know there is sufficient liquidity, it is sufficiently institutionally investable, and it is safe to invest in, as in you can custody it and you can trade it? So we go through this methodology where we start from the digital asset full universe of 8,000 something assets, and we start removing all of the ineligible coins. And those are either coins that, you know, should not be part of a portfolio for reputational reasons, but also all of the things that actually are not going to give you a crypto exposure, either because it's a stable coin, right? You don't necessarily want to have stable coins in a crypto portfolio because by default it's a stable asset. You're better off holding your dollars. And we remove all of the kind of direct stocks and everything. We want a crypto investable universe. So the first part is remove ineligible asset. We end up with a digital asset eligible universe. That is about 1,500 assets. So we've already skimmed down pretty much. Then we start removing the, we start adding the filters of the exchange ranking, the liquidity vetting, and we move down to this digital asset investable universe, assets that we know are actually tradable and investable, and we're already down to 150 assets. So we've significantly shrunk down the investable universe. And then we apply our own methodology, and we end up with KT10, which is our Kaiko top 10. And this is what we deem is a safe institutional investable asset universe, and we have a top 3, 5, and 10. So one of the things that I've been fighting against over the past couple of years is the market cap trap. Very often when we speak to people that are not necessarily deep into the weeds of that, they look at market capitalization, they sort cryptocurrencies by market cap. And this has bugged me since day one because, especially in crypto, market cap doesn't mean much, right? Because market cap, you take the number of assets, you multiply it by the latest traded price, and boom, you have a market cap. The reality is what we should look at is liquidity, is the natural organic market depth of those assets as they are traded on centralized exchanges, looking at order books, looking at like the market microstructure, looking at spreads, looking at liquidity, slippage, all these kind of liquidity metrics that are really a true reflection of an asset's organic liquidity and the industry's demand for that asset. So we try to really, avoid using or overweighting market cap in our methodologies, and we over-index on liquidity metrics. So here what we're seeing is the evolution of top 10 assets by market cap, and what we're showing is that it actually changes a lot. So if we only built methodologies on a market cap metric in the how do we decide which assets are included in the methodology, what we see here is that actually 28 different assets have been moving in and out of top 10 by market cap. So this actually would be difficult to maintain if we were rebalancing on a whatever frequency basis, whether it's monthly, quarterly. If we're rebalancing every time an asset move in and out of market cap, of top 10 by market cap, this would actually increase costs and create slippage and actually create a bit of inconsistency in the methodologies. not sure where I should angle this clicker to make it click. All right, here. Something else that we want to share is bringing you to the fact that we believe the right number of the investable universe should be somewhere around 10. If you look at 93 crypto assets that we deem to be investable according to all of our kind of building blocks and liquidity criteria and the blocks I've mentioned before, what we're seeing is out of that, only 2 are considered large caps. Obviously, those are Bitcoin, ETH, and we get, Solana in and out of that. When it comes to mid-cap, there are 7 that we consider to be mid-cap. And then everything else goes into what we call the small cap threshold bucket. So obviously, 2 and 7 are taken into our KT10 methodology, and then a mix of the smaller caps with different weights and into how they're included in the methodology. But yeah, what we're seeing is that actually it's really hard to get further down the number of 10 when you're building an index portfolio. And actually, there are a couple of indices. There's a top 20 that is done by not Kaiko, and there is another one that is quite famous, which is the Coinbase 50. Coinbase 50 currently includes something I think which is 20 to 25 assets. The goal is to go to 50, but even they're building and kind of marketing a top 50 strategy, but they know that they cannot realistically include more than 25 assets today. So it's interesting to see it in the data and to see that if you're trying to build, I think there's clear benefits in diversification beyond Bitcoin as you're building financial investment products, but going way beyond 10 doesn't make so much sense at this stage. So as I mentioned, market cap, very dangerous, slippery slope, and I think a misleading financial indicator for the health of and the investability of an asset. But we are focusing on liquidity. And liquidity is not just traded volume. Liquidity is also the availability of derivatives for those assets, enabling hedging and making the actual assets more liquid and with alternative hedging solutions. So here we're looking at our list of top 10 by liquidity threshold, by our own liquidity ranking. And what we see here is that all of these top 10 assets have access to both spot but also futures and options market in the US and in Europe. And that is really interesting. I mean, we work with one of our clients, Gemini, on the derivatives side. They have listed our top 5 index perps on their derivatives exchange in order to give exposure to a basket of 5 assets in a single investment product. So the availability of those derivatives markets for single assets is very important, and we are working with derivative venues in listing perps and futures on basket strategies, and this is the basket that we're pushing, which is a top 10. Just check on time. So now, the big question, should meme coins be included? That is a question that, depending on who you ask, you have a very different answer, and I let you imagine the kind of answer you have depending on the kind of person you ask. So we've done a survey. We've reached out to our 200-something clients, and we asked, do you want us to include meme coins in our index methodologies? And unsurprisingly, crypto people think that yes, we should include meme coins, and TradFi people think that, a majority of them think that no, we should not include meme coins. So it's a very obvious result. What I think is interesting is that in TradFi, I would have expected that it would have been even more binary, even more like absolutely not, we don't want to see meme coins. And I think it's a good indication that institutions are starting to understand why meme coins matter and why they actually bring this kind of very different, maybe almost unique to digital asset sense of community and belonging and network effect. And there is something that is specific to meme coin. Obviously, there is a long tail end of maybe less relevant meme coin, but in our KT10 we include Doge, and Doge is a kind of very powerful meme coin from a network effect standpoint, and also from a price action standpoint, actually. We're going to see that next. So what we're showing here is 2 charts. One of them is our KT10 with meme coins. I mean, I think Doge is the meme coin, the only one. And the same index without meme coin. What we see here is that actually they don't always add outsized return, and they don't always add crazy volatility either. Very high correlation, obviously, because of the weighting that never lets, given meme coin take too much weight in the given strategy. But what we're seeing here is that KT10 without meme coin is actually very slightly, from a price performance, slightly above KT10, which is interesting because very often when we talk to institutional clients, they think, oh, this is going to add crazy amounts of volatility, and actually those that are in favor think that it is a proxy for the general crypto health and industry and activity, and that thereby when the price goes up, any index with meme coin would actually go up more. What we're seeing here is that it's not necessarily the case. So now I talked about the methodology of building indices. We've shown data around the assets themselves. Now, when you have a good methodology, it's great, but it's not good enough with those kind of things. Data is critical, and it's very much garbage in, garbage out, or quality in, quality out. So here, Kaiko Indices is here on the right, and I mentioned all of the building blocks that enables us to administer regulated benchmarks that is used for the purpose of building mono-asset financial products, and also Kaiko Indices, which is kind of basket indices. But all these methodologies are great. What you need to funnel through is good data. So for those who are familiar to the world of market data and cryptocurrency, it's an extremely fragmented market. Centralized exchanges are numerous, and you get market data, which is like price data, order book data, and trade data from hundreds of different sources all over the world in real time. So you have to get all of this market data at the centralized exchange level, and we are in a world where DeFi is, I believe, the future. And so we are seeing very strong volume and growth on DeFi market activity. So obviously you cannot ignore all of the DeFi market data, liquidity pools, and trade data happening on DEXs. So there's a lot of work in being able to collect this data and standardize the data and put it in a database so that it is ingestible on the output. Regardless, the idea is that when you consume the data, you don't have to know whether this trade was from Coinbase or from Uniswap. It's a trade, and you need to be able to ingest that. So that is what Kaiko Data does, and Kaiko Data powers all of the index methodologies. And so what do you do with indices? Once you've selected your KT10, your top 10 indices, what do you do with them? So a couple of things. You can build indices that are going to power ETPs and ETFs. Currently, we work with most of the large crypto asset managers in Europe that are issuing crypto ETPs and listing them in Europe. ETFs, we've seen a lot of mono-asset ETFs in the US. Until now, we are starting to see in the applications more basket strategies and basket ETFs. And obviously, structured products. And all of the regulated derivatives. This is also important. I mentioned Gemini launching top 5 perps earlier this year. We are working with most of the regulated derivatives venues on listing perps on baskets and futures on baskets. This is also important because the second will have an impact on the first, because the more derivatives and perps you have on regulated exchanges on the same underlying that you are building ETFs and ETPs, the more hedging capacities you have, and this brings the entire industry up by providing liquidity and investability and more diversified exposures. All right, so this is what we do. This is how we build indices. The team is here. I'm going to be around, so if you want to follow up, I will obviously be available for questions, but thank you very much.